Hello, everyone, and welcome to Strategies to Exit Your Business and Retire. I think this is such an important topic and one that we need to make sure that we're out visiting about because it's going to become more and more important as people approach that time in their life where they're ready to exit their business and retire. I'm Chad Flanagan. I'm the partner in charge of our business valuation group at Eide. I get involved in this process mostly when the phone rings and client says, "Can you help me value my business?" And as we start to ask more and more questions, we start to ask, when are you going to sell your business? Who are you going to sell it to? Do you have enough to fund your retirement? And then we start to march down a more comprehensive exit planning process. And so I think that's a lot of what we want to talk about today, is that there's a lot involved in this, and we want to walk you through a lot of that step by step. I'm very excited to be joined by Kristen Tafe and Brad Kelly today. I work with Kristen on a lot of these projects from a valuation side and increasing value and looking at different options to exit. And then, of course, Brad gets involved with the non-business assets and looking at cash flows into retirement. And so, Kristen, will you please go first and introduce yourself?
Sure. Thanks for that short introduction. So my name is Kristen Tafe. I'm excited to be here. I have more than 10 years in the valuation and small business consulting field, and I enjoy helping clients with succession. I've been involved with transactions both on an internal side, so selling to an insider, whether it's family or a key employee, or an external side where we have helped clients find outside buyers, negotiate with those buyers, and hopefully close the sale.
And Brad.
Yeah, thanks, Chad. And hello, everyone. My name's Brad Kelly. I'm the principal in charge of Eide Bailly Financial Services and Wealth Planning. And as Chad mentioned, our team gets involved really leading up to the exit of the business, but really preparing the business owner for the post-exit and working on various strategies to implement after the transaction. And I have a few more years of experience than Kristen. I'll just say well over 10 years.
Yeah, thanks, Brad. And, I think to start, I just we'll take a look at some of these learning objectives. But the reason I say it's such an important conversation is we find so many clients really push this to the side. It's hard. The process is hard. It brings up unpleasant emotions. For a business owner, sometimes it's very difficult for them to face their own mortality, that someday they're going to have to exit their business. And so we need to be out talking to them and really encouraging them along with this process. And today we're going to kind of go through the various different steps, starting with identifying the objectives and goals of an owner. And then we're going to focus on making sure we measure what is the business value. And then we're going to go through, and Kristen's going to talk about how to increase the business value, and also look at different options that you have to exit your business. Brad's going to incorporate some cash flow planning as well as non-producing or non-business assets. And then we're going to wrap up with all the emotions involved in the transition of a business. And who doesn't want to hear accountants talk about emotions? That's what you signed up for. So hopefully that isn't, we joke about that, but it is truly an important part of our process. So as we think about what are we talking about when we're talking about exit planning, I think the biggest thing we want to emphasize there is that this is a very comprehensive process. There is a lot that goes in it. It's not just what is the sales price, who are you going to sell to, but it's how do we minimize tax? How do we make sure your goals and objectives are met? How do we make sure you're in control of that process and you're comfortable with that process? And it takes a lot of time. We'll talk later and show some slides on the success is very much correlated with the amount of time. So it's not something we can do in 6 months or a year. It's something that clients should be thinking about for 3 to 5 years and sometimes as much as 10 years. So we'll walk through some of those. And the other part to this is it's just good business strategy. We work with so many businesses that there's a lot of key person dependence on that business owner. They may have started that business, and to walk through that process, they need to make sure they're getting people ready, getting themselves ready. So it's good business strategy. And here's 7 steps that we'll walk you through today. Again, we keep talking about how comprehensive this plan is, but when you break it down, it's very simple. Starting with the owner objectives and goals, we'll talk about what's encompassed in that. We want to spend some time talking about the value of the business and then the different options, and we'll sprinkle in how this needs to be incorporated with wealth and estate planning and business continuity planning. So the big questions I mentioned, when the phone rings and they say they need a business valuation, and we back up a little bit and we say, when are you looking for an exit? We can help exit a business in 6 months, but that's really the only option at that point is to take it to market. There's not a lot you can do to help get the business ready, get parties ready, groom the manager, or get the management team ready, or those kind of things. And so we want to find out when this needs to happen. Next, we want to find out who we'd look to sell to, because strategies are very different. If we're looking to transition to family members, a lot of the strategy is driven by minimizing taxes. If we're looking to sell to a third party, a lot of the strategy is to maximize sales price and put a lot of profits to the bottom line. So very different strategies depending on who that most likely buyer is. And then of course, we want to find out what that sales price can look like, so we can really determine if you're ready for retirement. Do you have the funds necessary to fund that retirement? Brad's going to talk about that a little bit more. One of the most important things here as we talk to clients is just really what they want out of an exit, what's most important to them. And I always assumed, as I started to get into this work, that everybody would say that they want to get top dollar. And maybe that's what I would say. I want to maximize sales price when I exit this business. As I talk to more and more clients, especially around here, it seems like they have a lot of other more important objectives. I talked to a client recently that said, I want to maintain control of this exit. I want to exit to employees because I need this business to stay in this community. It's one of the larger employers. It's important to the community, and I don't want a chance selling to a third party that might have different plans. I thought that was, very interesting. And others really are building a legacy. They started the business. They want to maintain culture throughout that transaction. And so people are thinking about a lot of things. Some people hate paying taxes and really want to structure the deal around the smallest tax impact. So I just want to encourage you, as you think about what's important to you, that will drive who you sell to, when you sell it, and a lot of the strategy. And as we start to think about family held businesses and closely held businesses, we don't know what those are worth. Some of you maybe have had appraisals on your business. Some of you get offers from third parties, but it's important that you take the time to understand the value of your business. And there's different approaches to look at there. And a lot of it's dependent on future expectations of growth, managing risk, and those things. But it's good to go through that exercise, make sure you understand the value of your closely or family held business. After we feel like we know what that is, we need to look at what we need that to be to fund retirement. So we're identifying a valuation gap. If your business is worth $5 million and your financial advisor says you need $7 million to fund your lifestyle and your retirement goals, we can go to work on that $2 million. There's a lot of things that drive value, and with some time and management's direction can really go a long way to accomplish those goals. So for a lot of businesses, the value of the business can be up to 70, 80, 90% of somebody's net worth. And of course, it's important to look at those other non-business assets. And so Brad's going to talk about those and how we get our arms around the non-business assets.
All right, thanks, Chad. So, oftentimes when we get involved with clients, they're usually well down the path of exploring the transaction, and really, and rightfully so, the business owner is very focused on valuation, deal structure, who the buyer might be, and is so focused on that. A lot of times it's kind of forgotten about what about post-transaction and how should I be preparing for that. And so a lot of times I'll get the call from one of our CPAs that says, that we've got a client that's selling and the close is scheduled in a couple of days. Where should they wire the money? And so that's kind of a late time to be thinking about something like that. And so we tend to try to get involved during the transaction process, and simultaneously, if you think about it, it's two sides of the coin. You've got the exit of the business and the structure and deal structure and so on. But simultaneously, you need to be thinking about that post exit and how do I prepare for that as a business owner. And so a lot of times what I'll say is the mind shift is really moving from business owner to wealth manager and really preparing for that. And there are three questions to really kind of get the thought process going around that. The idea of being a wealth manager after the exit of the business. And these are three simple questions, but there's a lot of complexity underneath each one of these. But the first one is, what do I have? Just really looking at what do I have for assets and liabilities, looking at not just the value of my business, but other assets that I have, and what is my net worth, and how are my assets owned? How much liquidity do I have post transaction? And really thinking in terms of just kind of organizing the balance sheet. The second item is, what do I need? And really thinking in terms of once the deal has been closed and the proceeds come in to the individual's accounts, really what is the tax liability? We don't want to look at the gross number of the sale. We need to look at the net number and the post-tax liability, and really how does that fit into now starting to provide for what do I need, cash flow priorities, and thinking in terms of what does life look like post-transaction, what does quote unquote retirement look like day to day, what kinds of things do I want to be able to do to have the lifestyle that I want to have, and really trying to answer and identify what are my needs, and really starting with what are the day-to-day needs that I'll have, what are the wants that I have, what kinds of traveling do I want to do, or hobbies maybe that I want to start engaging in that I wasn't able to do when I was running the business. And so what do I want to do? And then finally, what are the wishes that I have as I think about some of the other things beyond, kind of extending beyond myself that I want to be able to achieve. Once you've done that, really define what do I have and what do I need, then really thinking in terms of, all right, now how do I get there? How do I organize this in a way that as I model this out into the future, I'm able to accomplish what my goals and objectives are? Oftentimes I'll get asked, am I going to run out of money? What does that look like as I forecast out? Oftentimes we'll model those scenarios out for individuals and show, yeah, you might run out of money based on what your priorities are. Or oftentimes the opposite happens where, yeah, you're actually able to achieve your goals and objectives, but the compounding effect of the assets that you have really continue to kind of drive more complexity out into the future, and really kind of forecasting and looking at that. So the best way to do that is to really have what we call a wealth plan, financial plan. There are a lot of terms that are used out in the marketplace, but really having a plan that focuses on a number of components that are all interrelated and work together. And this is not really a one-time event. This is something that is ongoing and continuous on a going forward basis. So it must be monitored and it must be managed because priorities change, or the landscape of the environment changes, new tax laws come out, and things happen that will require an individual to revisit the wealth plan and make adjustments according to what's happening at any particular point in time. But you can see the components that are made up of a wealth plan that should at least be contemplated and considered when you're looking at the post exit, taxes and managing taxes on an ongoing basis, investments. And you think about, you're taking an illiquid asset in your business and turning it into a very liquid position. Now, what do you do with that? How do you deploy that? And what does that look like? Insurance, really thinking in terms of stress points on the overall plan as you forecast forward. And then finally, how do you transition wealth in your estate plan? What does that look like? Probably looks different post-exit than it did when you were running the business. And so making modifications to that. And then the last one is retirement, which is more about lifestyle on a going forward basis. So a little bit on each of the components. With regard to taxes, I'm not a CPA, but it is a big part of the piece that we provide to our clients. And really, we think in terms of 3 levels of managing taxes, planning for taxes. The first one, just what can I do today? And I kind of think of this in terms of you're still in the business, you're running the business, operating the business. What can you do today to reduce taxes at an individual level, but within the framework of your business? There are many ways to do that. One example of that would be just really looking at, if you have a retirement plan in place, 401k plan, really looking at that, looking at plan design and thinking in terms of, is that designed in a way for me as the business owner to maximize the contributions that can be made into that plan? Is the 401k plan enough? Can I stack a cash balance plan on top of that? Can I actually take cash flow that's happening now, defer that in a way to, again, position and prepare myself for post-exit? So that's one of many examples. The next level is really thinking in terms of, can I reduce taxes out into the future? What can I do today to reduce taxes in the future? And an example of this would be more post-exit. But a lot of times on the post-exit, and you have a liquidity event and implement an investment strategy, if it's done in a very tax favorable way, you can maybe suppress tax brackets down a bit. And so if you're able to put yourself in a position to manage tax brackets, your tax bracket post-transaction, then you can look at strategies like taking the qualified money, the retirement plan money that you've accumulated over your working years, and maybe converting those into Roth features and doing conversions, and doing that in the way of managing your tax bracket, but trying to reposition assets today in a way to have a more tax favorable treatment in the future. And then the last one is just finding ways to reduce taxes over a lifetime. This really gets into more of the estate planning piece, but there's a lot of buzz right now about, with tax reform, the exemptions coming down from where they're at today. And so there's a lot of activity going on right now about gifting assets outside of an individual's estate, utilizing the exemption today and really pushing growth of assets into the future outside of the estate, and really trying to mitigate tax liability down the road. So those are all elements to consider within the context of an overall wealth plan as it relates to managing taxes. The investment strategy, there's some language here on the screen, but really for me, as I think about individuals that all of a sudden, as I said, now have high level of liquidity. If you have $6, $7, $10 million, $20 million, whatever the case might be, what do you do with that cash after the transaction? You just don't go and dump it all into the market in one day, or at least I'd advise against that. And so how do you deploy that in a way that contemplates your overall wealth plan and really considers the timing of when you need access to those dollars for whatever reasons, for gifting reasons or lifestyle reasons? And so there's really 3 components within the context of the plan that you really didn't need to be mindful of when it comes to the investment portfolio. The first one is cost, and cost include taxes, but also includes the fees based on the products maybe you're investing in, or the management fees or transaction fees. But all of those will have an impact on the overall end result of the investment experience, and they need to be really considered and thought through. The other 2 components are related, and it's risk and return. And certainly, as far as managing risk, the more risks that you're taking on inside of your investment strategy, the more expected return you should expect to have. But really thinking in terms of how much volatility can my portfolios withstand in the context of my overall wealth plan. And so those are all elements to consider when thinking about the investment part of the wealth plan. The insurance piece, that's, the way I think about this is the stress points that really happen to the overall wealth plan in the event of death, or maybe even a long-term care type situation, and really thinking in terms of, if death occurs today, what are the stress points of the overall plan? Is there a tax liability on the estate that I need to be considering because I haven't had time to implement the various strategies that I've been wanting to implement? Or are there things that I need to fulfill, that obligations that I made to charities, maybe that I've, have made commitments over a 5-year period that I'm going to be giving to a certain charity. And so I want to protect that. And so really understanding what those stress points are, and then really thinking through, can I, within the context of the wealth plan, self-insure that? Do I have the assets there to step in and fill that gap? Or do I need to consider some type of product to fill that need? And if so, really understanding what product makes sense for that particular need and how to best deploy that. The next component is the estate piece, and there's a lot of complexity here. And a lot of times this gets addressed either leading up to a transaction or certainly post-transaction. And this is a process that really has to contemplate a number of things. It really has to look at, what does the net worth look like today, and decisions that I need to make today. But as I forecast out into the future, how can I make decisions today that will accommodate or address the projected growth of the estate out into the future? And so really thinking in terms of today and the future. A lot of times I'll see individuals thinking in terms of their estate plan just today only, but it really needs to be looked out into the future. The fair and equal discussion is a big part of estate planning, especially if an individual leaves a business and there are heirs that are still in the business, still operating the business, and you have kids that are in the business, kids that are outside of the business. How do you position wealth in a way that keeps things fair and or equal? And so there are a number of strategies that can be deployed there. I think another factor that comes into play here is the timing, the age of an individual when they're moving, or when the transaction or the exit event takes place. Somebody that's in their 50s and they sell their business, the runway is much longer than somebody that's in their 70s. And so the estate plan needs to address the issues today, but have flexibility in place as things change down the road based on kids growing up, spouses that they're marrying, grandkids, things that maybe don't even exist today, but will be part of the future. And so somebody that's in their 50s has to think about the estate planning a little bit different than somebody that's in their 70s, where they kind of see where their kids are at and how life's kind of playing out, and can address it a little bit differently. So it really depends on, where you're at from a life stage standpoint. But the overall estate plan needs to contemplate a surviving spouse, next generation, the kids, certainly the generation thereafter, if the wealth's large enough to really consider generation skipping strategies and thinking about, second generation down, and then charities as well. There are things that can be done from a charitable standpoint while living, and there are things that can be done upon death, and those things need to be considered. And then the last thing I would say here too is that oftentimes for individuals that go through this exit and liquidation event and have sizable net worths, is really having the family engaged in the estate plan and really being a part of that. How do you engage the kids and or grandkids into the overall estate plan to prepare them for the eventual transition of wealth? And then the last part of the wealth plan is the cash flow piece, and really thinking in terms of, again, cash flow needs today, cash flow needs out into the future. And it's really all about ensuring that, or giving yourself the best chance of having the lifestyle that you're wanting to have. And there's a balance there between all the other components of trying to fulfill an estate plan, minimize estate taxes, but not jeopardizing your cash flow needs at the end of the day as well. And so all those elements are interrelated. And then to just summarize, really more what this looks like is just the steps, as I said before, starting off with what is the net worth? What does the balance sheet look like? What's the liquidity in the balance sheet? Illiquid assets? What assets are income producing? What assets are there for consumption? And really reviewing and analyzing that. And then cash flow forecasting. This is so critical in thinking in terms of post-transaction, is just modeling out into the future expected inflows, expected outflows, rates of return, inflation factors. As all of that plays out, what happens to the wealth as all that's forecasted, and where are the stress points? And then finally, just the flow of the wealth upon death, and what does that look like, and how does that get to the heirs? A lot of this really hinges on ultimately the value of the business and what can you get out of the business from a valuation standpoint. And that's where Chad and Kristen's team really come in and really assist with that, trying to maximize valuation leading up to a transaction. So Kristen, I'll turn it over to you.
Wonderful, thank you. So like Brad said, the business valuation is really key in understanding that potential gap between what you have and what you need to develop your wealth plan. So it really answers that question of what do I have that Brad posed earlier. There's a lot of reasons that a business valuation are important. Likely a buyer is going to have a valuation performed. If they're looking for bank lending, the bank will often ask for a valuation to support that purchase. For the seller, if they have something done on their end, then they're going to make you an offer likely based on some sort of multiple. For the buyer, the seller needs to know, is that offer any good? For example, let's say that you've heard 4 to 6 times EBITDA in your industry. Well, how do you know if you're the 4 or the 6? That if you're on $500,000 of EBITDA, that could really be a pretty big difference in what those end results look like. How do you support negotiating from the 4 multiple up to the 6 multiple? So that's really where we need to see the valuation in a transaction. Is the business worth enough to support your goals? Are your expectations of what this business is worth reasonable? We often see this on both ends. So just to give 2 examples. The first example is a service-based company. The owner's expectations of value were nearly double what the value truly was. So we came in and we said, you might be shooting a little bit high. I think this is more what we can expect. And they said, no. Our name in this market means everything. They planned their retirement around that number and brought it to their potential buyer. However, once talking to that buyer who was reasonably sophisticated, it was clear that the offer wasn't going to meet the seller's pricing that they were expecting given the level of cash flows. So they were overvaluing their name. It didn't translate into actual cash flows. They weren't able to come to a deal, and that was the best potential buyer, but they had built their wealth plan around a number that was really high. On the other side of things, we had an owner that was going to sell to a key employee based on a metric that they devised internally. However, given their growth in revenue and earnings and their huge backlog of opportunities, it was really undercutting what the value is actually worth. In that situation, the key employee would have been able to hold on to the business for a year or 2 and sell it for nearly double what it was purchased for. And it was really based on the value built by owner 1. So it would have been based on the fact that that individual got such a steal that they would have made the money back by selling to a bigger player a couple of years down the road. Business valuation is not fixed. So if you got a valuation done in 2015, what does that mean for today? And I think that we all know, even, especially with COVID, a lot of business values have been impacted, but even without that, it just isn't always going to be the same. Items impacting value are constantly changing. So not only do we have to think about the industry and economic factors, we have to think about, have you increased your profitability? Have you diversified that customer base? Have you added a new product line? All of those mean that that valuation that was performed a couple of years ago is just no longer relevant. For example, right now, if you're maybe a civil engineer, the investment in infrastructure is really going to help increase the value of those. So something that was a few years old is just no longer going to be relevant for you. All right. So really overall, the importance of a business valuation, there's a few other factors. Number one is it can help you grow the value of the business. So Brad had asked the question, if we have a gap in what I have and what I need, the question is, how do I get there? And this is something that will help with that. If we have a business valuation done, we know where we're starting from. So we can put in place certain metrics, and we can utilize those metrics as a way to motivate employees to help us to reach those, where we want to end up. If transferring to a key employee, how do you identify the value in that transaction? Even if the key employee knows the operations and they know everything that's been happening, do they really know and understand the financials? This would be their opportunity to understand what they are truly buying here. It builds confidence that the offer is reasonable for both players. And lastly, it would be, are we utilizing valuation discounts? So this really comes into play if there's going to be some sort of gifting involved or non-cash compensation to a key employee. Do we want to utilize those discounts to try and reduce the taxable impact? The goal of creating these the goal in business valuation is often to identify what drives value here. So we have a big list here. It's not all encompassing, but a big list of items that help to identify transferable value. So transferable value refers to what the business is worth to somebody else. So not necessarily to you, but if somebody else were to step into your shoes. No matter which exit path you choose, transferable value is going to be the common denominator to having a successful exit. Insiders won't be willing to acquire your business if they can't run the business without you there. So if there's a lot of key person dependence, then they're going to say, I'm not going to offer you as much because this thing could collapse the minute you step out of operations. If you're going to pass the children, or if you're going to pass the business on to children, you really need to ensure that they understand what is in place and that it can continue without you. And third-party buyers know that if the current owner is going to be leaving the company, what are they buying? Is it reliant on that owner? Is there anything left once they exit? So strong value drivers are really what makes the company a desirable acquisition opportunity, regardless of whether it's a sale to insiders or external parties. So like I said before, these are just some value drivers. It's not an all-inclusive list, but we are just going to go over some of them today. The first one is a management team. Is the management team established? Do we have a lot of key person dependence on an owner or even another party who may exit under new ownership? The thing we like to consider there is, if you were hit by a bus tomorrow, what would happen with operations? Is there anybody else that has those connections or the know-how that could help things to stay on track? In an example, we're working with a client currently where the owner was also the key salesperson in operations. The owner passed away very suddenly. The impact on the business operations is significant. Right now, there is nobody out there selling additional product to try and keep revenues into future years. There's so much reliance on that person's role in the business that it really impacted what it was worth in a sale. Another business value driver is the business systems, the established and documented business procedures and the business procedures that you use to just make things happen on a day-to-day basis. Can the system support the business after you leave? Or is everything based on a, wait, we use this shortcut because that doesn't actually work? Due diligence is going to uncover some of those shortcomings, so it's better to be prepared and start trying to fix those now. The customer base. Buyers typically look for a customer base where no single customer accounts for more than 10% of total sales. A diversified customer base insulates the company from the loss of major customers. For example, if your top customers generate 40% of your sales, the buyer may be concerned that if one or more of them were to leave in a transaction, the ownership changes, then suddenly, what am I buying if everybody's gone? We actually worked last summer on a project where, while we were working with the potential buyer, the largest customer, who did account for approximately 45% of revenue, exited. They decided that they found somebody else and they were going to go there. They had no idea a transaction was in the process, so it wasn't related. Immediately, it had a huge impact to operations. We knew, looking at the future revenue opportunities and expense structure, that the business was no longer going to be profitable unless they could replace that. And it was 45% of revenue. So trying to replace that is a very big ask. There was minimal ability for the owners to focus on replacing that customer at the same time as looking for a potential buyer and going through with the due diligence process. And it had a large impact to the purchase price. Another one to think about is the facility. If the facilities and equipment are clean and organized, it communicates the message that the business is also clean and well organized. Business value can be impacted if if all the equipment has been just run to the end of its lifespan, and the new buyer is going to have to make a large capital expenditure on day one, essentially, to keep operations running as they always have. The business strategy. Buyers will pay premium prices for companies that have a realistic strategy for growth. Is there a written plan in place describing the future growth and how you're going to achieve it in the context of industry dynamics and demand for the company? A detailed and properly communicated plan helps to attract buyers, especially if previous plans especially if you've actually met those goals previously. So if you can show that pattern of this is what we've done in the past and this is how we've met those goals, that's a big thing to see. This is more than just numbers hard keyed into a spreadsheet. This is actually saying, here is the client listing, here's our marketing efforts, and this is how we anticipate it's actually going to be reflected on a financial. The financial controls. Effective financial controls support the claim that a company is consistently profitable. So they want to be able to see that those controls are in place, and it gives them a feeling of confidence in the underlying financials. Overall, a buyer is going to be buying cash flow, and I think that's really important to remember. If we have those other items and the intangible assets in place, for example, if you feel like your good name and your reputation in the industry are all going to lead to this, something that you can sell at the end of your time in a business, it should be translated into cash flows. So overall, all value drivers contribute to growing cash flows and to showing a stable cash flow stream. We want to focus on ways to operate the business more effectively, more efficiently, increasing productivity and decreasing costs. So really the cash flows should be the output of some of the other items as well. So exit routes for business owners, we really have three to consider here. The first one is a sale to an outside party. The second is a sale to an inside party, or a gift to family members. We're going to talk about sales to third parties first. So the upside here is that it may be the top dollar option. You often get paid quickly. It's likely a quicker transition process. And often there's no seller financing involved. But the downside can be that you're going to lose control of the corporate culture. If that's something that's really important to you as a seller and a current owner, then that would be something that you don't have any impact on anymore. They could change the name of the business. They could change the location. So if it is that business that is a big employer for the community, you don't really have any say in what happens there. Chad had mentioned earlier that we aren't only focusing on price, sellers aren't only focusing on price. We want to say that too, but even from the financial aspect, we aren't going to only focus on price. We're going to also look at terms. First, are we looking at a stock sale or an asset sale? Typically, third parties are going to push for an asset sale. That means they will be buying the assets of the business. They don't want to be stuck with any liabilities and potential skeletons in your closet that they just don't know about. The asset sale works great for the buyers because they can assign a portion of the purchase price to different groups of assets, and then they can essentially redepreciate. However, from the seller's perspective, it's just not as advantageous in terms of taxes. Sellers typically prefer the stock sale because of those tax advantages. However, the buyer isn't going to like that because they're essentially stepping into the shoes of the seller. So that means they're responsible for any potential future liabilities in that entity. And there's just a few more unknowns there. And in addition, they don't get the advantage of depreciation. It's likely that all the assets have been fully depreciated. The buyer may be open to a stock sale, but it probably will impact purchase price. We also encourage potential sellers to consider how the payment of proceeds will work. Is it 100% cash up front? Is there an earnout over a certain number of years? Is the buyer asking you to stay on for an additional number of years to assist with the transition? What happens to your employees? Will they be happy with the sale to the third party, or do you see them leaving? Does the buyer want to keep the management team in place? And if so, are we structuring stay bonuses or something along those lines to encourage them to stay under the new ownership? There's a few ways to sell to a third party. So there's the orderly liquidation. It happens often, but hopefully you can avoid that with proper planning. And that's really just the sale of the tangible assets of the business. A sale to a third party where somebody's going to pick up the operations and continue them. Recapitalization, which is an infusion of capital from some outside party, often private equity or just another investor. or an IPO, which we see more if it's going to be a new and exciting technology or you have really fast growth. And sales to insiders. The key here is, have you identified key people that could take over operations? You can sell shares to co-owners, to key employees, to an ESOP, or family members. When selling to an insider, there's a mix of 3 components that should be considered. Ability, experience, and dedication of the new owners. Are they actually able to do this? Are they able to take on this responsibility? Do they have the necessary skill sets, or can this person gain those skill sets? Does the company have a strong and consistent cash flow? And is the transaction designed to prevent income taxes from eroding that cash flow? Oftentimes, these individuals are going to know the business inside and out, but they may not have the funds in place to actually buy the business outright. And so we often see seller financing coming into play on a sale to insiders. There's a lot of strategies that can be put in place to transition ownership to an inside party, while making sure that you retain the sufficient cash flow to keep funding the needs for your retirement and to keep the business operating in a nice way. There could be some sort of stock ownership program where you utilize metrics and people receive a portion of company stock as a bonus. This is where you could end up going to an ESOP. Overall, sales to insiders will often involve seller financing, where you're essentially funding the sale with future proceeds of the company. All right, and now back to Brad and Chad to talk about the emotional considerations.
Thanks, Kristen. Yeah, as we talk about the emotions and how important they are to this process, I've been given this presentation for a long time and starting to be known as the emotions guy or the harmony guy. I'm not sure how I feel about that, Brad. That's why I'm having you sharing this with me today, so I can spread that around a little bit.
I'll do my best.
We do think it's so important. I think because as we've worked with clients, we've seen how this plays out. And, when we say succession is never just about succession. What we mean by that is so much more than just where the shares go, what are the cash flow, what are the taxes. It's really about that seller, and are they ready for the next chapter of their life? What are the emotions involved in that, as well as in situations where you are transitioning to management or family. Are the buyers ready? There's a lot of emotions with taking over a business and assuming those kind of responsibilities. So we've learned to incorporate this into the comprehensive exit planning process. Many years ago, working with a client, I really put together a good plan that really addressed all the major topics, and we kind of got them to closing day. And as we did that, they really paused and said, "I'm not ready to do this. I'm not ready to not see my clients tomorrow or my employees. I'm not ready to turn over the business." And we had not had a lot of conversations about readiness and what they're going to do with the next phase of their life. And so it really played out in a bad way, created some hard feelings. And we've learned to really hit those kind of things, the objectives and goals at the start of the process. We started asking questions like, do you have hobbies? What are you going to do? Are you going to take up golf? Some people are very much ready for retirement, others not at all. And if it's time, then it's time to start to think about that and what that looks like. And hopefully it's not this generation 2 pushing out the first generation, but that it is a win-win for them. Brad, have you seen any of that?
I have seen, you see it all the time. And, you see business owners that they're running their business day in and day out. They're leading up to this exit event, and they're so focused on that they really haven't even processed the idea of the emotional side of this after the fact. And so, we really think in terms of, Chad, when we're working with clients, is we're trying to really get to, how does this person view the business? Is it a legacy? I think you mentioned this earlier, and really helping the business owner kind of navigate the emotions of that. Or is the business a tool simply to provide for a standard of living and a lifestyle? And the emotions that go around that, just depends on where the person's coming from and what's driving them. And I would just say too, we oftentimes, as when you're working with the spouse of the business owner, as an example, are they emotionally prepared? for the transition as well.
We've really incorporated that into what we call the social contract. So as you decide whether you're ready to exit the business, first of all, talk with your spouse, try to understand, what do you and your spouse look for out of this business? Is it legacy? Is it an opportunity for your kids? Is it monetary, where it's just a tool? There's no right or wrong answers. And then even as buyers are coming in, are you and your family ready for this? It's a huge commitment. There's a degree of risk. And are you ready as a family unit to assume those and chase that opportunity? So we talk with buyers that say, no, thank you. Thanks for the offer, but no, thank you. It doesn't fit with what our social contract is for this business.
Yeah.
So what does a successful transition look like? The thing I think about that where clients fall down usually is they get very excited for the process. They start it, we work through a plan, and then we check in 6 months or a year later, and the business has grown and there's all kinds of other responsibilities, and this is pushed to the side. So it really does take a strong commitment. A good plan acknowledges the emotions involved. And then as you think about, relationships within the business and who could be the next successor, make sure you're putting the business first. It's hard to do, but what is best for the business? We try to remind those stakeholders to keep that top of mind as they work through this process. I mentioned this at the top of the discussion, which is why is this so hard? Think about a family business where you're trying to decide which of your children is going to start to run the business and assume the president role. That's going to be some very difficult conversations. I think that's in big part why we want to start this process so much earlier than most people think, is that it takes time to set expectations, to have those conversations. Sometimes having a third-party facilitator come in and talk with the ownership group, the management group, potential buyers and or family members can be a good way to get information where it's too difficult to talk to each other, that you just need some third party to come in. I'm often surprised with how quickly and trusting people are to open up to us about their goals and objectives in a business.
That's a very formal process that a group can go through. And even though it's an emotional aspect of this, how can you actually go through a process to gather information and have data to help navigate the emotional aspects of it? And so I know there are, as you said, bringing in third parties to facilitate a process to navigate that. We've seen a lot of success of families and closely held businesses that have gone through that.
As we think about family businesses specifically, because there are some unique considerations when you think about the relationships within a family playing out in business. The number one thing I probably see is that generation one might be on a different page from generation two. And so if I'm close to retirement, I'm probably not taking a lot of risk. If I'm just getting into the business and I have all these great ideas, I'm trying to grow this thing at 20% a year, I'm willing to take some new risks,
Right.
Try some new things. So some of this comes down to just business strategy, risk tolerance, those things. I worked with a client where mom and son just were butting heads every day. And the arguments almost always stemmed to mom was trying to be safe and conservative and son was trying to grow really fast. So do we hire this employee? Do we buy this equipment? It wasn't that they were just on different pages and they never really sat down to talk about it. I will mention too that it's part of a family business. We do some work with Prairie Family Business Association, and they have lots of programs and do some education and some networking with peers and some programs that can be really helpful. So if you're in a situation of family business, look at those organizations. They can help with a lot of these things. Brad, I think the other thing that we see is just the rules that they may be set in place for what is the role of family members and non-family members. Some businesses will say you have to go out and work at some other business for 5 years. Go learn, there, and then we'll find a spot for you inside. Do you ever see anything like that?
Yeah, and you see things like that all the time. And I think that the best, I mean, you look at the stats and we might be showing that, but the chance of the longevity of a business from one generation to the next is so dependent on just good, solid planning around that and having a plan in place. And so, how you're preparing that next generation to step in and take over the business is so important, and it needs to be just well thought out. It's just not something that just happens naturally or organically. I think it does to some degree, but the more you can plan around that, the better chance you're going to have of having a successful transition and longevity of the business.
Good point. Just to wrap things up, and we maybe have a couple minutes for questions. If anybody has any, want to use the chat feature, we'd be glad to take a look at that. Last thoughts are that this process is very comprehensive. We'd like you to start as soon as possible as you think about your options. Creating more time, giving yourself more time creates more options. It's something you have to commit to. It will be something that will be easy to push to the side, but it will pay dividends. We really want to make sure you get you can monetize your life's work with these businesses, closely held and family businesses, and that there is a lot to think about, and that you want to create opportunity for your people or family members, or again, just make sure you exit in the proper manner. It takes a lot of time and planning. Any other thoughts, Brad and Kristen?
Kristen, anything?
I think that there's a lot of tools that you can use to try and increase the value of your business. So if you are experiencing that gap between what your business is worth now and what you need to fund your retirement, there's a lot of opportunity there to try and improve the value before you're really ready to exit.
Yeah, and I would just add, obviously this topic right now, it's a hot topic because there is a lot of activity going on in the marketplace in this space. A lot of venture capital money that's out there. It's, is it skewing valuations? Is this, is this a small point in time to really capture some valuations at a higher level? There's just so many dynamics when you think about the marketplace itself and what's going on there, Washington and what's going on, and then you come back inside of the business and all the internal emotional aspects that we're just talking about. It's a lot to navigate, and I think just having a team around you as a business owner that can help navigate that in times like now is just absolutely critical.
Brad, we're obviously seeing that in terms of the demand right now for wealth planning services and business valuation services. So many clients are finally ready. Maybe they've been incentivized by potential tax changes. It's a good M&A environment. Yeah. And some sellers are just, they don't want to think about living through another pandemic with their business. And it's really pushed planning to the forefront. And we're seeing a lot of activity right now. Not seeing any questions. So we thank you all for joining. Please, feel free to reach out to any of us if you have specific questions. And thanks for listening today. Have a great day.